You are in the meeting now.
May I kindly request the professor to take off their caps? I open this session with a prayer. May the spirit of wisdom and mercy grow and blossom in all of us. Please be seated. I welcome you to this academic session on the occasion of the public PhD defense of the dissertation by Michael Vo. And this PhD committee consists of several professors. Many are from Tilburg University, the supervisor, Professor Joost Driessen and Professor Stefano Casello, and members of the jury are Professor Vregen, then we have Professor Frank de Jong and Dr. Thomas Grünthaler. From abroad, we have Dr. Christy Janssen joining us from University of Southern California. Before the defense, I would like to give the PhD candidate the floor to give a concise summary of his research in terms that can be understood by a wide, broad audience. Please go ahead, Michael.
Yes, thank you, and welcome to my public introduction of my PhD thesis titled Price to Perfection, Subjective Expectations in Financial Markets. As you can guess from the title, my work has to do with expectations. And why do we study expectations? Because they are key ingredients to financial markets and asset pricing. So in my work, I aim to answer three key questions. The first one is, are expectations of financial investors rational? And if they are not rational, in which direction are they deviating from rationality? And what are the characteristics of these potential deviations? To answer them, I have used multiple approaches. In the first chapter, I studied the beliefs about future dividends. In my second chapter, which is joint work with my supervisors, Stefano Casello and Joost Driessen, I have studied beliefs about future variance after a shock in expected variance. In the final chapter, which is joint work with my co-authors, Luc Renderbach and Hulai Zhang, I have studied beliefs about future variance before the companies are sued in a security class action lawsuits. So without further ado, in my first chapter, which is titled Forward Dividend Growth Expectations, I start from the very fundamental questions in asset pricing, which is why do stock prices vary? And according to the present value identity, stock prices changes because a combination of these two things. The first one is changes in expected returns. The second one is changes in expected dividend growth. And existing research in the literature, they have long been assuming rational expectations, and this literature have found only a very small role of dividend growth expectations in explaining price variation. And this has to do with the difficulty in measuring expectations directly. So to solve this difficulty, I measure dividend growth expectations from option investors and from analyst forecasts. What I have found is that dividend growth expectations, they are not rational, but instead they overreact. And these overreactions, they can predict future returns of dividend-based assets. If you would like to see the overreaction in action, I would show you this graph here. There's a lot going on in this graph, so please allow me to take you through it. On the horizontal axis, we have the time, which are the years surrounding the financial crisis, which is highlighted here as the black dashed line, which is where the Lehman Brothers Bank went bankrupt. Now I would like to draw your attention to the black solid line, which is the realized dividends actually being paid out during this time. The lines in colors, they are expected dividends, and they are measured from option prices on some particular dates. For example, let's look at the yellow line. They are from option prices on the date of the 29th of December 2006. So at the end of 2006, investors, they expect the S&P 500 index to be paying about 8 cents per day in dividends for the first half of 2007. Now the overreaction here comes from the pattern that, as you can see, before the crisis, for the yellow line and the green lines, they are somewhat about the level of the black line. So expected dividends and realized dividends, they are about the same level. However, after the crisis, as you can see in the red line, is quite a bit below the black line. So expected dividends, they react in the correct direction, which is downward. However, the magnitude is magnified, and we term this overreaction. And it takes about a year until beginning of 2010, at the blue line that you can see is now about the level of the black line again. So it takes about 1 year for this overreaction to revert. Now in the second chapter, which is co-authored with my supervisors, we would like to study variance expectations. And we know that they matter to option prices. And we also know from asset pricing theory that in financial market, investors, they would form expectation both about the first moment of returns, which is the mean of the distribution of returns, and also about the second moment of returns, which is the variance. Now, most research in the literature, they have focused on the first moment at both the index level and the firm level. There's a very, very large literature on that. But about the second moment, most work has been focused at the index level. So there's a gap in the literature for us to study variance expectation at the firm level. And the results that we have found is beliefs about future variance at the firm level. They are not rational, but they overreact to firm level shocks, but underreact to market level shocks. And these deviations from rationality, they have real impact on asset prices, where we see that options with higher variance shocks, they overreact and they become more expensive. To see this overreaction, we can look at this graph here, which plot the alphas of the Fama-French 5 factors index, of the Fama-French 5 factors model. On the horizontal axis, we have 10 portfolios, going from 1 to 10. That is going from portfolios with negative variance shocks, so variance has decreased, going to the 10th decile with positive variance shocks, which means the variance for this portfolio has increased. And here we can see that because of this overreaction, the alphas are very, very negative, suggesting that these options, they are overpriced. Now, in the final chapter, which is titled Class Action Lawsuits and Option Markets, co-authored with my co-authors Luc Renneborg and Hulai Zhang, we study option market reactions to securities class action lawsuits. And what we have found is that option traders, they treat the filings of the lawsuits as important information events, where we see that implied volatility, they would increase before and peaks at the filing date, but only for the settled cases. For the cases that are eventually going to be dismissed, we see that implied volatility is much, much flatter. And we also see that the option traders, they can assess the quality of a lawsuit and predict its outcome, where we see that changes in implied volatility, they predict not only the outcome of the lawsuit, but also the settlement amount, even after controlling for the stock market. And what about the variance premium? In the paper, we have found that the variance premium would increase after the filing event. And this would suggest that these firms they have become more risky to option traders. Here is a graph that's showing that implied variance would react differently for cases that are eventually going to be settled and cases that are going to be dismissed. Keep in mind that the outcome of these lawsuits, they are not known at trading day 0, which is when the lawsuit is filed, but usually they are known many years in the future. If we see the average lawsuit being settled or dismissed after 2 years, then it will be trading day 500, which lies outside these graphs. However, even at trading day 0 or even before that, we see that the option markets, they react differently to cases that are eventually going to be dismissed and cases that are going to be settled. Thank you for listening to my public introduction. I hereby declare that this thesis is my own work and that during my PhD program I operated according to the principles of scientific integrity, honesty and scrupulousness, critical attitude and transparency, independence and impartiality.
We will now proceed with a round of questions by the exam committee, and we're going to start with Dr. Janssen from University of Southern California. Please go ahead, Christy, your first question.
Right. So, Michael, you wrote a very interesting thesis with great insights. So let me go straight into my question. So my question is about chapter 1. So you find evidence of overreaction in the way investors form expectations about future dividend growth. So when dividend growth is high in good times, investors forward expectations about dividend growth becomes too optimistic, and of course vice versa when dividend growth is low in bad times. Now, table 3 of chapter 1 shows clear evidence of predictability in forecast errors. My question is, how should we think about the magnitude of the coefficient that we find? So for instance, at the 1 month horizon, you find a coefficient of a negative 0.25. Is this a large or a small number? Or differently phrased, so let's assume that everyone in the market overreacts. What should we find in terms of the coefficient? And that's my question.
Highly esteemed opponent, thank you for your question. So before I answer the question, let me give a bit of background about the methodology of this table and the regression that I put here. Here on the left-hand side, I have the forecast errors calculated by by the forward rate and the spot rate, and on the right-hand side, I have the forward rate. And now, if we want to think about the magnitude of these coefficients, then first we need to compare it to the benchmark. Here, the rationality would predict that this coefficient should be 0, so that the forecast error should not be ex ante predictable. But here we have found that all of these coefficients, they are significantly below 0, which except for column 2, where m is equal to 2. But then if we talk about the magnitude of these coefficients, then it's a bit tougher to interpret. So that's also one of the reasons why I refrained from interpreting these magnitudes. But then if you think about how the forward rate is going to change, one unit changes in the forward rate would be going from, for example, if we're going from 0% growth rate to 100% growth rate, then this would be, the coefficient would be the change that we see in the forecast errors, which is defined as the difference between the spot rate and the forward rate. So if we take column m equals to 12, for example, where the coefficient is minus 1.27, if we have a change of the forward rate going from, let's say, by 50% So going from 0% to 50%, then the changes of the forecast errors would be half of this coefficient, which would be about 0.06%. So it means that the gap between the forward rate and the growth rate, the spot rate and the forward rate, which would be about 60 percentage point. And so we will see not a one-to-one change in this, but this coefficient, they can be interpreted in that way. I hope that answers your question.
If I just a brief follow-up. So I was alluding to sort of what would happen if like participants extrapolate or overreact a lot. Have you, for instance, looked at time variation in the coefficient periods where a coefficient would be higher or lower? If you can elaborate a little bit more on that.
Yes. So I think in the beginning we also had the idea that these coefficients, they could change over time. So there was analysis that we didn't report, but where we interacted this variable with a dummy that would turn on only when there's a crisis. But then in the sample that we have going from 1996 until 2022, we didn't have that many crises in the sample, so we didn't have significance on the interaction term. But I think that could be an interesting avenue for future research, where we explore how this coefficient is going to change over time. So the degree of overreaction, how it's going to change when the macroeconomy changes.
Right. Thank you.
Yes, thank you.
If you're satisfied, Dr. Janssen, then we're going to the second committee member. So now I turn to Professor Vregen.
Dear Michael, thank you for writing a really interesting thesis. I have a question about chapter 2, in particular about the sentence on page 59. You write, furthermore, the finding is also robust to including long-term realized volatility measured in the past 1 year in the VAR system as shown in Appendix G. Appendix G is on page 113. If we look at those results, I'm not sure that they're really in line with the statement. In multiple ways. So I basically have a set of questions. A, why did you only include the realized variance, the long-term realized variance in the first equation, especially given its importance? So if you compare the R square of the first equation in table G1 with table 2, then we see that the R squared doubles when we include the long-term variance. So that begs the question, why not include the long-term variance in the other equations? Right? Mm-hmm. So that's the first question. Also, we see that the loading on the long-term realized variance is very high, and the loading on the short-term realized variance becomes a lot smaller. And if you look at your impulse response functions, arguably one of the most important results in this chapter, we see that your effect becomes half as large. Right? So seeing all these results, my conclusion is it's very important to include the long-run variance. And not the results are robust to including it. So could you maybe elaborate a little bit on that and also explain why the realized variance was a long-term realized variance was not included in the other sets of equations?
And this is esteemed opponent. Thank you for the very insightful question. So I agree that the long-term variance is a very important variable here. So including it in the first equation is a must-have, because there are research showing that short-term variance. To predict that, we need also the short-term variance and the long-term variance, and I really appreciate your feedback about that point. Why didn't I include it in the other two equations? Well, the first one would be coming from that it's not clear why implied variance, which is about an expectation about variance going forward, or the returns or the excess return, would depend on long-run realized variance. And then there would also be the second reason, is that this 1 year of long-term variance, they would also be affecting these two variables of IVIT and RIT, coming from the fact that it would also include the short-term realized variance, RVIT minus 1, in the second and the third equation. And yes, and then we had to opt to have the long-term realized variance to have its own equation in terms of AR1, because the horizon of this variable is quite different from the other variables. And so it's hard to think how the very short-term realized variance or implied variance or short-term returns can affect the 1 year long-run realized variance. And of course, if we think about the how robust the results are in compared to between table 2 and table G1, then we would find that most of the coefficients, they would retain the same size and magnitudes, except for the very first equation, which is the realized variance short-term on its own leg, which is 0.11 in table G1 and about 0.05 in table 2. But for the rest of the coefficients, they are similar in magnitudes. And I do agree with you that the effect of the on the IRF on the impulse response function is almost half, coming from about 0.11 until 0.06. However, this halved effect is still statistically significant, as you can see in figure G2 of page 114, where we see that the confidence intervals of 95% is outside zero. So that's what I meant when I say that the results are robust to this to the inclusion of this variable, because we still have the same overreaction effect, albeit with a lower magnitude.
Would it not maybe be a good idea to write that in the main text? Say, okay, this effect survives, albeit a little bit smaller than in the main analysis.
Yes, I see your point, and yes, if I did not include that in the main text, then is my mistake there, and in the next version of the paper, we'll definitely need to revise that to be clearer about the magnitude of the effect has been halved by the inclusion of long-term realized variance.
I will be looking forward to that version of the paper.
Yes, thank you.
Thank you very much, Professor Vlegen. We now turn to Professor Frank de Jong.
Thank you. Well, dear candidate, dear Michael, well, first let me compliment you on a nice thesis. I'm sorry I could not be at the pre-defense because I was actually on vacation in your home country, Vietnam. But still, I had some questions before the pre-defense, and you have some answers to that in the final version of the thesis. However, I still have some remaining, some questions remain here, so that's what I will focus on. And my main question is about the predictive regressions that you do in chapter 1, or the tests of whether the forecast errors are predictable. So if you look at your equation 4, so basically what you do is you regress the future realized dividend growth on the forward rate. So the future spot rate you regress on the current forward rate, and that if the expectations are correct, that coefficient in that regression should be equal to 1, and that's basically what you test. You find that the beta is much smaller than 1, so somehow the forecast errors are predictable, and you interpret that as overshooting of the forward rate, and somehow that expectations are biased. Now this type of regressions is quite familiar to me from the term structure of interest rate literature, where the same type of regressions have been proposed by Fama already like 40 years ago. But from that literature, the interpretation of the results tends to be very different. It tends to be that there are risk premiums in the market, that these forward rates somehow also reflect the risk premiums, not only expectations, and that the beta smaller than 1, or predictability of forecast errors, points at time-varying risk premiums in the market. Now that explanation could actually well be true here as well, because you don't actually have expectations of dividends, but you have prices of dividends from derivatives, and the price could contain a risk premium. So I think the risk premium explanation here could also hold. So that question I already asked you way before the pre-defense, but you come back to that question in Appendix 2 on page 45, and there you write down an equation 29 to be precise. You can look it up maybe. That's page 45 of your thesis, the very last equation. Yes. Then you say that this forecast error contains a risk premium for on t plus m, and the difference between two other risk premiums, both observed at time t. And you claim that these risk premiums cancel, and therefore they should be small, or at least they almost cancel. Now, I'm not completely sure where that conclusion comes from, because I can understand that the term in brackets, the two risk premiums observed today, cancel, but this risk premium at time t plus m, which is basically the discount applied to the dividends at time t plus m, does not disappear. And I think you also see that in the picture that you showed in your introduction, that right after the crisis, the price of the dividends was actually much below the actual dividends, so that could be a price discount. So that at least to me tells me that there are risk premiums in the market. So I think you dismissed this explanation quite quickly and without much discussion. So my first question here is, okay, can you sort of underpin your conclusion that risk premiums are small a little bit better? Secondly, and I think economically more important, I'm not dismissing the expectations explanation either, right? Well, both could be true at the same time. There could be and risk premiums and some overshooting in or biases in expectations. But could you somehow tell these two explanations apart? Or could you say which one is more quantitatively more important? Or what would you need to make such statements? So I'm looking forward to your answers.
Highly esteemed opponent, thank you for your question. So about the first question, as I understand it, then your question was about the risk premium terms and whether or not they would cancel. And here, so if you look at equation 29 on page 45, then the cancellation is between the RP t plus m and the other two terms in brackets. And the other two terms, they are actually, they are both the risk premium at time t, but with a different horizon of the discount. So in the sense you can think of the two terms in bracket as a forward premium term, and then the RBT plus M as the spot premium term. And now the question is whether or not these three terms would all cancel out together. And I do agree with you that if there's a time variation in risk premium, and if the time variation is large, then it would be difficult to make this claim. That is one of the reasons why this paper would not be complete without the data from analyst forecast from IBES, because that data allows us to look at dividend expectation in a way that is not contaminated by these risk premium terms. As for the option data, then unfortunately there's no way to filter out these risk premium terms. But if we look at, if we compare the results between the IBES data and the option data, then we see a similar pattern. And also the magnitudes could also be a bit different if we compare the coefficients. For example, the one in table 6 on page 30, where we have the IBES data at horizon m is equal to 12. And then the closest comparison of that would be in table 2 and table 1 at the last column m is equal to 12. And there we see that the coefficients, they are very close to 0, which is about minus 0.003 in table 1 and minus 0.07 in table 2. And if we look at the table 6, then the coefficient is about 0.3. So this difference in magnitude, it could be attributed to the risk premium term. However, the benchmark of rationality that we compare this table to is that the coefficient should be 1. So I would say even after we take into account the risk premium terms, then the overreaction effect could still be very significant.
Okay, but could you somehow, translate the difference between these coefficients to an estimate of the risk premium or something like that? I mean, that's. I'm just thinking a bit aloud here.
Yes. Then. So it would be that well, a change in the forward rate in the IBES data would give us about so a change of 1 unit in the forward rate of the IBES data would be about 0.3 of the spot rate in IBES, but it would make the option data spot rate to change to the opposite direction of about 0.7. So then, and then the rationality benchmark would be that it should be a 1-to-1 change. Then I think that it really depends on what is the variation of the risk premium that we are looking at here. So off the top of my mind, I don't think I can work out the changes in the risk premium from the math, but I think that it will be worthwhile to compare the magnitude of these two coefficients together.
Okay, that's fine. Thank you.
Yes, thanks. And for your second question, which is how to tell apart which is the effect coming from the risk premium and which is the effect coming from the overreaction effect. Then yes, I think my previous ideas would also speak to that, where if we look at the IBES data, then that would be free from the effect of the risk premium. Yes, thank you.
Okay, thank you.
Right, then we move to Dr. Grünthal.
Dear Michael, my question goes in a similar vein or similar spirit. You use option prices in all 3 of your chapters, and most of the time you interpret your results as belief-driven. However, an alternative explanation could be that there are some frictions, such as intermediary constraints or segmentation, that drive your results or explain your results. Can you think of ways to disentangle the two or include it in your paper? I think you already do that a little bit by providing the additional explanation or evidence with the IBIS data, but yeah, can you think of ways to disentangle the two explanations?
Yes, the highly important. Thank you for the very interesting question there. And I think it's something that we have spent a lot of time thinking about when we work with options data. And yeah, there's no running away from the fact that in option prices there are risk premium, and then everything that we infer from those prices would be risk neutral expectation. So that's why in the first chapter it was very important to get the analyst forecast data. And then for other ways on how to disentangle that, then I think the first thing is that we also need to look at the horizon of the data that we're looking at. Because if we think of, if we use option prices that are very short term, then there is research showing that the retail investors in recent years, they really the very short-term options, like 1 week or below, they're very popular with these retail investors, which can cause a lot of demand pressure, which could also be one of the frictions that cause, for example, put comparity to fail. Now, I think that there's also some research going on that would endeavor to translate the risk neutral expectation into a physical measure one. I think Jack Worth has a paper in that sense, but I'm not sure if he's still pursuing the venue. But I do agree that there's a lot of room to growth in that direction. There's also the Ian Martin method, where he looks at option prices and then translate them into, for example, expected returns of a stock or expected returns of an index. And now that method depends a lot on how the math from Ian Martin works out. But in my experience, a lot of papers in the literature have taken these estimates of expected returns to be the physical measure expectations. For example, one of the papers that are one of my key references, the Gomsen et al. Paper, they use Ian Martin method of extracting expected returns from options and use that as a subjective expectation of returns going forward. But in that paper, they also use survey and forecast, because they also subject to the same critiques that we all have. And now, in terms of frictions of the option market, then if we think of how the option market is evolving, then we have a lot more, let's say, capital going into the option market. I think the market has been growing a lot from 2005, I think, since CBOE improved the system. So I think for now and in the future, we could have a lot more option trading and also longer horizon option. They could become more liquid and then could also help us gain more insight into the long-term dynamics of these variables. But then to disentangle on the frictions of the option market for expectations, then I think that for now the literature doesn't really have a clear answer. So I think it's now would be best to think of option data as one prong of the trident, and then we need to complement it with other data from surveys and perhaps also from surveys that we run ourselves. Thank you.
Thank you.
Very good, and we are going to do a second tour de table, and we move again to Southern California and reach then out to Dr. Janssen.
Right, so Michael, my second question is on chapter 2. So you find strong evidence that's consistent with overreaction to variance news in the cross-section of stocks. Now, considering that you're going to industry, suppose that you're working for an institutional investor, so think of a pension fund like CalPERS or APG, or an asset manager like BlackRock. How would you use your findings in your job?
Highly esteemed opponent, thanks a lot for the very interesting question there. It's also something that I've been thinking about when I choose my next destination. So if we look at chapter 2, then one of the findings is that we have a spread portfolio that would give us above 15% in returns per month. But then we also know that this trading strategy is, first of all, has a quite high transaction cost, and also the fact that these options trading strategy, they can be quite skewed. So in the paper, I think we found that these trading strategies, they can be very left skewed. So they pay off almost like a lottery. So in a way, I think this might not be suitable for pension funds, but for other institutional investors. For example, hedge funds, they might be interested in this kind of strategy, where it's essentially they are selling insurance to the overall market, where you want to bet against the firms that has very high variance shocks lately, and I think for them it can be quite a good venue. But then I want to note that in the paper it's not a real-time trading strategy just yet, because now the trading signal is coming from the VAR that we run on the full sample, and then we back out the error terms of this VAR. So in a way, it's not a real-time trading strategy, but one of the things that we can do is, for example, we can run the VAR every period with an expanding window, and then with that we can have a real-time trading strategy, because we can form the trading signal every period with only past data, so there's no look-ahead bias. And then we could also perform cross-sectional analysis, in the sense that because right now we find that this new overreaction effect that we find that is not explained by any of the pricing factors in the literature. We have looked at the Pharma French 5 factors. We have looked also at the mispricing factor by Stembout and Yuan. We've also looked at the very new IPCA factors from Goyo and Serretto. And then we find that the effect on the alphas of these stratos is still there. So, so that's why we are interpreting this effect as an overreaction effect. But then it could be very interesting to these hedge funds, for example, because their benchmark would be, for example, the CAP-M or the Pharma French 5 factors. And so this could really yield alphas to them.
All right, thank you.
Thanks.
Thank you. Then we move to Professor Frey again.
Yeah, Michael, my second question is also about chapter 2, and in particular about a statement on page 52, where you write, first, whereas a rise in option implied variance at the market level can reflect not only changes in beliefs, but also changes in investor preferences, and the pricing of systematic risk, variance shock at the individual level are largely idiosyncratic, where idiosyncratic is defined as relative to the market. So, could you elaborate a little bit on that? Because, you know, what's idiosyncratic with respect to the market could be not so idiosyncratic with respect to other risk models, right? Mm-hmm. So do you really need that risk model, and how would your findings change if we thought about another risk model as the workhorse? Would that maybe bias your coefficients in a set of equations in the VAR? I don't know. Could you maybe think about that?
Highly esteemed opponent, thank you for your question. So here we defined idiosyncratic variance risk in the sense that this variance are not moving with respect to the market, but only to variance news of the firm. Now, one of the thing about the option variance risk is that there's not a clear model in terms of factors that would outperform one another just yet. I think now we have some models that are newly developed, for example, by Goyo and Serretto, but before in the literature there's no consensus pricing factor like in the stock market, where we have the French 3 factors or 5 factors. So then if we propose any pricing model, then it's difficult to think that what good these factors are. So to be conservative, in the paper we use only the market as the primary factor, and then everything that is not explained by variance of the market, then we think of that as idiosyncratic. And and then I think in one of the appendices, when we find that this idiosyncratic risk is variance risk is about they take the majority of the variance risk at the firm level. So with these options, then I think this the R square was about 5% only of the variation is explained by the market factor. So the idiosyncratic variance risk would be about 95%. And then we think that if you think that this idiosyncratic risk, then they in principle should not be priced. But then of course there are papers that are showing that idiosyncratic risk can be priced, especially at the stock market. But then it's not clear at in the option market when you look at idiosyncratic variance risk. Are they priced or not? Then I'm not sure if there are papers about that just yet, but if they are not, then I think this also could be a very interesting for a new paper. But I think that if we want to, let's say, change the variables in the VAR, then we also need very compelling motivation. Why should we change this? The variables in the VAR that we have, it was inspired by the paper by Loxley and Muir, that's 2022, where they also used these variables in their paper of the VAR. One of the small contribution that we have is that we have the expected variance also computed within the VAR itself. But for Loxley and Muir, they compute the expected variance from an external model, the HIR model by Corsi 2009. So this would mean that in their paper, the internal consistency can be called into questions, because they have two equations for expected variance. But for us, we only have one equation for expected variance, and it's calculated within the VAR. Now, of course, adding variables to the VAR is an endeavor in and of itself. But I think, for example, long-term variance, they could be very worthwhile variables to add there. But then the difficulty would come in the sense that because it's a very sticky variables when we look at long-term variance that's calculated over 1 year. And then if we calculate in the VAR at the monthly level, then because of the difference in frequency, the other variables at the monthly level would be moving a lot, but the long-term realized variance would be very persistent. And this could introduce some problem that I think as of this moment I cannot foresee, but I do think that there is definitely value in expanding VAR. I think one of the things that we thought about was including also the market variables within the VAR. For example, we could have the realized variance of the market or returns of the market.
I understand. Thank you.
Thanks.
Professor De Jong. Yeah, I also have a question about chapter 2. So you make extensive use of impulse responses to do your analysis, and you calculate these impulse responses from a vector autoregressive model that is presented on page 57. So you have a 3-equation model with realized variance, implied variance, and returns. I understand that. But then you do something, at least for me, quite curious, or which is in equation 3, where you extend this with an expected realized variance term, which is like a deterministic function of the 3 other terms. And then you study what happens, or you use that particular structure to calculate these impulse responses if there's a shock to the expected variance. Now this highly confused me, and I think I've asked these questions before, and I think your answer is even more confusing, because so what exactly is the shock that you are studying here? So what in terms of the epsilons of the original equations, 1A, B, and C, that's sort of the basic equations, right? The uncertainty is in the forecasts of realized variance, implied variance, and returns. So somehow there's a shock in expected variance, which must be a shock to a combination of these 3 variables. So then you calculate impulse responses by looking at what happens if the error terms in equation 1 change. So which exact shocks are you studying here? Is it a shock in epsilon 1, epsilon 2, epsilon 3, some linear combination of that? And sort of economically, what does that mean? So how should I interpret your impulse responses?
Highly esteemed opponent, thank you for the very insightful question there. So first of all, let me start off with answering your first question of why did we include this new equation into the VR system, and why didn't we do it any other way? So in the VR system, first we have 3 variables: realized variance, implied variance, and excess returns. And then we ask the question: how should we calculate expected variance from these 3 variables? Now, of course, we can always choose to shock a direct combination of these 3 shocks. But the reason why we chose to explicitly write down the 4th equation for expected variance, the first reason is that we want to be explicit that expected variance is coming within the VR system itself. So it's not something that we calculate from an external model, like in the Logston Mill paper, where they calculate expected variance from the Corsi model. And then next.
Maybe I understand that you want your expected variances to be consistent with the VAR, but that doesn't mean that you have to put them as an additional equation in the VAR. That part confuses me. You can just have the VAR and then from that back out the forecasts for expected variance. You don't need to add that as a fourth equation. I mean, I don't understand why you do that.
Yes. Highly still important. Thank you for the follow-up. And then, yes, I agree that it would be much more elegant to shock directly a combination of these three, and then to get the impulse response function for the expected variance directly. I think I try to map the math of that in your note with the impulse response function that I have here. And then
but even before you read any note of mine, you came up with this particular specification. So I'm asking why you do it this way, because I find it very curious. I've never seen it before. So.
Yes. So yes, as I was saying, I did it this way so that I could be explicit that the expected variance is there from the system, and then the next is that I'm also. It can be explicit about the fact that the shock to expected variance is a linear combination of the other three shocks. And then we can see that they are rho 1, 1 and multiplied by the first shock, rho 1, 2 multiplied by the second shock, and so on. And then if you look at table 2 on page 73, then they would be the three coefficients on the first column of RVIT. Table 2 on page 73.
But is your implicit assumption then that all these equations, RV, IV, and R, are shocked by the same amount, and then you multiply them by the predictive coefficients? Is that sort of the implicit assumption there that you use?
So we estimate three shocks from the data itself, and then we multiply it with the coefficients here that we have in the first column, and then we see that expected variance shocks, they load a lot on the shocks to implied variance, which in this case is very intuitive because implied variance is also a forward-looking variables, so they are quite similar to expected variance. And then,
I think you're confusing a few things here, because these are the coefficients of the lagged variable. These are not the coefficients of the shocks, right? So.
Yes, but if you look at page 57, then in equation 3, then at the end I define the vector epsilon it. And then we can see that the final shocks, the last shocks, they are a linear combination of the other three shocks. Rho 1, 1 multiplied by epsilon 1 it and plus the other shocks.
Sorry, but then if I look at that equation, so your impulse response is like a response to a unit shock in this in the error term. So then is this a response of a unit shock to the sum of all of these terms, or is it a response to a unit shock in each of the epsilons, so epsilon 1, epsilon 2, or epsilon 3? These are different things.
I understand what you mean now. Yes. So now after we write the VR system with 4 equations. And now we have also a fourth shock, which is the expected variance shock. Then the impulse response function would show the effect of one unit shock to the. I think it was one step deviation shock to this new shock, which is the linear combination of the other three shocks.
Okay, thank you.
Yes, thank you.
Dr. Grünthaler.
Michael, in chapter 3 of your thesis, you study lawsuits, which is arguably a tail event for the stock price of the company or of the firm. Can you maybe briefly explain why you focus on at-the-money options or at-the-money implied volatilities instead of out-of-the-money?
Highly esteemed opponent, thank you for your question. So, there are quite a few reasons why we focused on at the money instead of out of the money. The first one is about concern for the liquidity of the data. we know that at the money options they are much more liquid than out of the money, and also we did look at out of the money options, and then we found that the patterns are quite similar to that of at the money options. It's just that we have a bit more noise. So one of the key consideration at the time was that we want to get as high liquidity as possible, because now we're looking at options at the firm level.
This session is adjourned for deliberation. Please wait for the committee's return. Dear candidates, the doctorate board of Tilburg University has taken note of your dissertation. Having heard your defense, the doctorate board has decided to confer on you the doctoral degree. Professor Joost Driessen is authorized to invest you with this dignity. Let me first congratulate you with this fine result. And here we have.
It gives me great pleasure to accept the task assigned to me by the Rector Magnificus of the University. By virtue of the authority granted to us by the law and by the regulations of the University, in accordance with a decision by the Doctorate Board of Tilburg University, I hereby promote you, Hong Phuoc Vo, to doctor. You acquire hereby all the rights that by law or custom are or will be attached to the doctorate. Apart from rights, a doctorate also comes with obligations. These, first of all, include the execution of research and all other scholarly activities with the utmost integrity. The privilege of being a doctor also entails that society needs to be able to rely on the sound and independent judgment of those holding a doctorate. Do you promise to act according to the principles of scientific integrity and future scientific research?
Yes, I promise.
As proof of you having been awarded the title of doctor, I hand you the certificate, signed by the Rector Magnificus and the supervisors, and confirmed with the university seal of approval. Oh, perfect.
Spontaneous situation, I know. Yeah, one more. Great. Go ahead.
I perform a pleasant task, learned sir, in congratulating you on behalf of Tilburg University's doctorate board with the dignity acquired. Congratulations. Well done.
Yes, thank you.
I would like now to give the floor to the supervisor for the pronunciation of his laudatio. Please be seated.
Dear Michael, dear Dr. Vo, and let me start with congratulating you, your family, and friends, either present here or online. Right? This is also streamed all the way to Vietnam, I would guess, with this great achievement. PhD, a PhD in finance in Tilburg is not something you do overnight. It takes many years of effort and dedication, and today, right, is a moment where you can finally celebrate that this journey has been completed. Let me also thank the committee for all the feedback and the comments today and during the pre-defense. I know it's quite an investment, right, to read through a whole PhD thesis, but I hope also for you it has been interesting. The comments have been very welcome. Now, a special mention to the committee member is Frank de Jong, because for this he also helped not only with comments for the thesis, but also for the laudatio. As he just mentioned, he recently visited Vietnam, and one of the things he saw there was the so-called Temple of Literature, which you might be familiar with, which is part of the oldest university of Vietnam. And apparently, well, you probably know this better than we do, but students still go here to touch stone turtles for good luck with their study program and their exams. Now, of course, I do not know if you also went there, right, to ask for good luck on your PhD thesis. But if you did, it clearly worked out. Now, another thing, at the temple, there's also a sign that mentions actually the responsibility of academic scholars. And you just pronounced the text, or you confirmed the text, right, that we read out that Tilburg uses. But let me also mention the Vietnamese ones, and then we can see how similar they are. So according to the Vietnamese guidelines, a good PhD graduate will be, first of all, commending laureates and encouraging study. Second, asserting the role and value of talents. 3, teaching scholars of moral responsibilities. And 4, encouraging the good and preventing the evil. So that sounds a bit more ambitious, actually, than what we ask of our doctorates. Anyway, back to you, Michael. You came to Tilburg in 2018. You started gently with the Master of Finance, right? The regular Master of Finance program. Then you thought, well, let's take it a bit step higher, right? To do the Research Master program in Finance, which is a 2-year program. And you passed with very good grades, the Research Master. And hence you got easily accepted into the PhD program of the Finance Department in 2021. And then, right, we directly set up the supervision team with Stefano Conazella, who's next to me, and myself. And that's all good, but then the hard work starts, right? And the first project you started to work on is a project on under and overreaction in option markets. Well, this is a whole journey. I mean, you use different methods, the Koybon-Gorodnichenko regressions, VAR models, and so on, trading strategies in options. And you have interesting finding, right? Overreaction in the option market. And this is the option market for individual stocks, while the literature mainly looked at the index options, where there's a different pattern, right? So that was interesting. And you also worked with projects with other colleagues, right? With Peter de Groei, you actually worked on a paper for more that what initially did in a Master of Finance, right? Which is a very different topic, eye tracking the information, right, that funds give to investors, and see how investors deal with this information. You actually went all the way to the US to present this work, so that was quite an experience. And another joint project with Hulai Zhang and Luc Wennewoog, who's the chair today, became part of the PhD thesis. Right? In that paper, you investigate the behavioral options again, but now looking specifically at the announcement of class action lawsuits. You find that option markets somehow anticipate the occurrence of these lawsuits and the outcome of these cases. And then there's a good practice in Tilburg, right, that a third project is a job market or a single author paper, and you came on a topic, again, related to option markets, but applied in a very different way again, to see what we can learn from options, and later on also survey data on the expectations of dividends, right? And particularly look at sort of not realized dividends, but you look at forward expectations and realized expectations, essentially, right? The dynamics of these expectations. And again, you find evidence for irrational behavior, again, evidence of overreaction. So those were the 3 papers, right? And together with the 4th project with Peter de Groei. Now, as I said, a PhD is not an easy route. And I think everybody, many people here in the room have a PhD. For everybody, this comes with ups and downs, right? You also had periods where things went smoothly and went sort of uphill, but there were also periods where progress was slower. You also had to stay in Vietnam for a bit longer for family reasons. But it was good to see that, right, when the finish line was a bit closer in sight, that you stepped up and finished all the papers. I think you can be really proud of, right, of finishing this long-term endeavor that a PhD is. And I also think you fitted well in the group. You interacted well with the other PhD students. You were an important asset, to the PhD group, and also in general to the department with your presence. And of course, as a supervisor, there are some things that you don't really hear then, right, about the interaction you have with PhD students, but and the things that go on. But indirectly, I think I did get at least a vague idea of sort of how much fun the social program was of the infamous Spanish Finance Forum conference. A conference that you attended with several other Tilburg PhD students. And even though nobody told me directly, I think many interesting things happened over there. But perhaps we can talk about this later today. Now, I mentioned several times already that PhD is hard, but there's one thing that is harder in Tilburg, and that's the weather, right? And especially for somebody that comes from close to the equator. So we've seen that only above 30 degrees, you would start to dress down somewhat from the winter jackets, sweaters, and so on. I've seen you cycling, where I would come without a coat or something on my bike, and you would look like it was quite deep winter in the Netherlands. So in a sense, it's very fitting that today we're officially still in the winter, in the Dutch winter. It's almost 20 degrees, right? So it's very fitting that today this weather is so good. Okay, Michael, so on behalf of Stefano, right, and myself, let me congratulate you again with the achievement, and we wish you all the best in the future, professionally and personally. Thank you.
This brings us to the end of this academic session. On behalf of the Doctorate Board of Tilburg University, I would like to thank all the committee members. Given that we will congratulate the candidate directly after this session, I still would like to give the opportunity to Dr. Janssen in California to say a few words to our candidate.
Right, so thank you, Luc. And Michael, congratulations on a great thesis. Like I said before, you gave some very interesting insights that definitely contribute to the finance community. Now, I want to wish you good luck with your next job and presumably in the industry. Make sure that today you celebrate and definitely enjoy the nice weather outside. I wish you all the best and enjoy.
Thank you, Chris.
Thank you, Dr. Janssen. May I ask the guests who are present in the auditorium to leave the room after the cortege, row by row, starting with the family in the first row. I now close this session. May I invite you to stand up, please, and ask the professor to leave their caps off. For your blessings, we thank you who lives and loves through all eternity. Amen. The session is closed.